Chapter 13 in our study of introductory economics is all about financial products and the financial markets. There will be three things we'll be doing in this chapter. The first is taking a look at savings and investment concepts. Then the tools that are used with regard to those savings and investment concepts, the financial market products, and also taking a look at the parts of the financial system. Let's get started. Let's start our look at savings and investment concepts by making sure we understand some fundamental terms. The first one we'll consider is the word investment or term investment itself. What is an investment? Well, simply stated, it's the use of assets in an effort to earn income or profit. And there are two key points related to this. First, the consideration that the profit motive encourages investment, and the second being that for our society and for us personally, investment promotes economic growth. The second fundamental term I'd like for you to be familiar with is financial asset. And what is a financial asset? It's a document representing the claims of an investor. In other words, proof of having made an investment or actually having money in an account. Now, financial assets are also called securities, and please note the root word here, security. The whole idea behind this is that if you're putting money in an investment or having money saved in an account, you're trying to secure your future. So that's why we call a financial asset a securities or security. One other piece of advice here in today's modern world, many of you will probably wind up doing your banking online or electronically, and either having your bank statement sent to you via email or checking it on a website. I highly recommend that you get in the practice of periodically or once a month printing out your bank statement and putting it in a file and keeping the statements for a number of months and then culling them out over time. The reason for this is that, heaven forbid, if we ever have a technology failure and so forth, you need to have a physical copy or proof of asset of your financial asset, and the only way to do that would be to have a copy of your bank statement. So that's just a good practice for our adult world, even though we're moving to the electronic environment, to get in the habit of doing. So keep a physical copy as well. Here are two other fundamental key terms. Somebody may ask you about your investment portfolio. And what your portfolio would be a collection of your financial assets. Over time, you might collect quite a few different types of financial assets, such as stocks, bonds, other types of savings vehicles like certificates of deposit, and the like. And when somebody asks you about that, they're asking about your total investment package, your portfolio. The next one is a prospectus. This is simply an investment report on a investment vehicle or a financial asset that's provided by a financial advisor or an intermediary. This could be like a stock report recommending or telling you about how the investment has performed over time. And the word intermediary, if you're not familiar with that, what it means is a go-between or representative, an agent or a broker. A licensed intermediary must purchase financial products on your behalf. And that's a good point. To buy stocks and bonds, you need to go to a licensed broker to do that, to make those investments and open up an account with a brokerage firm. And the intermediary, the broker, will very likely provide you with a prospectus or investment report on the types of investments that you may want to consider putting your money into. Let's now quickly look at the concepts of risk and return. Risk is defined as the possibility of suffering loss. Return, from a financial perspective, is defined as the profit an investor receives above and beyond the sum of money that's initially invested. Now, there's a very important concept that you need to keep in mind with regard to risk and return in investments. The higher the potential return on an investment, the riskier the investment is going to be. Also, beware of Ponzi schemes. Now, I'm going to be talking about how a Ponzi scheme works in the Course Resource Center, but just shortly here, Ponzi schemes are very similar to, if you may be familiar with, pyramid schemes or frauds, or a house of cards, if you will. That was first developed by, and I can't remember if his first name was John or Joseph Ponzi, back in the early 1900s with regard to financial investments. And just recently, and this is the example I'm going to be using in the Resource Center, the United States federal government busted the world's largest Ponzi scheme ever that was bilking investors of in excess of tens of billions of dollars just around the time of the 2008 financial crisis. And it was the Bernie Madoff Ponzi scheme that I'll use as the illustration of the pyramid scheme with regard to investment products. But you need to be aware of those. I guess there's an old adage to be applied here too. If an investment sounds too good to be true in terms of its return, it probably is too good to be true. One additional fundamental concept with regard to risk and return that you need to be familiar with is the concept of diversification. And diversification used with regard to investment products is defined as the following: the strategy of spreading out investments to reduce your risk. And I have here the question, why would you want to do this? And I'll answer that in a second by providing you one simple example as a reason why. But before I do, I want to point out that this seems like a pretty logical, simple, straightforward, and sensible idea to spread out your investments to reduce your risk. And interestingly, this idea won somebody the Nobel Prize for economics. Harry Markowitz, back in the mid-1900s, came up with this theory of diversification, or rationale that people should diversify their investments, and was awarded the Nobel Prize for it. Kind of interesting. Okay, so why would you want to do this? Well, I'll give you a simple, straightforward reason. More than half of all new businesses fail. So don't put your money or all your eggs in one basket, if you will. Diversify your investments out so that you can reduce your risk. And I say that even if you're going into business with a family member, hedge your bets and make sure that you're protecting yourself in terms of reducing risk. In the image in the upper right-hand corner of the screen, here we have a graphical example of an investment portfolio that is diversified. You have some money in stocks, some in gold, bonds, and you keep some in cash. You may have some money invested in a specific business as well. So take diversification seriously. It's a good practice. Now we'll move on to taking a look at the most common types of financial assets. And we're going to start with bonds. And in talking about bonds, I'm going to start with three fundamental facts about bonds. The first is that a bond is a loan that represents debt that either a government or a corporation must repay to an investor. Many people like to say that when a government issues a bond for sale or a corporation issues a bond for sale, the government or corporation is actually turning themselves into a bank or an investment organization, in the sense that the person purchasing the bond is loaning money and they're going to get a return. Secondly, bonds are usually considered a safe, this is from the risk and return standpoint, a safe investment for the investor, and that's an advantage. Now remember that the principle here that if it's a safe investment, the return is probably not going to be as high as some other investment that it's a little bit riskier. And this holds true for bonds. The rates of returns are usually lower on bonds. And why are they safe investments? Well, particularly so for government bonds, because it's not very likely that a state or local, or for that matter, the federal government is going to go away and not be able to repay the bondholder. Either repay the bondholder the amount which is due at the end of the bond term, or make the interest payments on the bond. The governments are going to be around. Quite frankly, I like to say it this way, that if the government disappears, either state, local, or federal government, we're probably going to have some greater concerns than redeeming our bonds that we bought from the governments. So government bonds are considered very, very safe investments. I should probably add one other thing here in the spirit of full disclosure. There are some people that are raising concerns over the safe investment aspect, especially with regard to the federal government, with the growing debt that we have, and whether that national debt, that is, and whether the federal government's going to have the ability to repay. But we'll see about that. On the other side, a corporation issuing bonds is a little bit riskier. Now, I say that because, sure, a corporation could go out of business and default on bond payments. There's no question about that. But the other side of that coin is corporations are fairly large, well-established businesses, and that doesn't happen all that often, especially not from a surprise standpoint. So they're still considered relatively safe investments, maybe not quite as safe as government, but still safe just the same. The third fundamental fact is that bond prices have an inverse relationship to interest rates, meaning that when interest rates are up, bond prices are usually down or decline. And that would, giving you further detail on this would require a rather lengthy explanation, too long for here during this presentation. But I will be in the Course Resource Center discussing the reselling of bonds, and that in that discussion it really clearly illustrates this inverse relationship that the bonds have with interest rates. So don't miss that explanation in terms of how bonds are actually resold in a secondary market. Back in Chapter 12, the banking chapter, when I introduced you to loans, I gave you a few fundamental terms with regard to loans, and some of those terms were actually components of a loan. Here I'm going to give you the four components of a bond, and you'll find, because bonds are actually loans, that some of the components and terms are very familiar to you based upon having looked at loans in the past. Here's the first, the term maturity. What that means as it relates to a bond is the time or date payment of the loan amount is due back to the investor. If I purchase a $10,000 bond that's a 5-year bond, the maturity date is the 5-year date out of when the payment of the original loan amount is due back to me. Second term to be familiar with is what they call par or face value. Most people call it the principal, but financial advisors will still use par and face value in place of principal. And what that is referring to is the actual amount that is paid for the bond that will be repaid at the maturity date. I used the example a moment ago of a $10,000 bond. The $10,000 would be the principal, the amount that I paid for it or that I'm lending to either the government or the corporation. Coupon rate is the interest rate paid to an investor. And the yield or total return refers to the rate of return that the investor will receive when the bond is resold prior to the maturity date or redeemed at maturity. And to the note I have here saying discuss discounts, as I mentioned a couple of moments ago, I will be discussing in the course Resource Center the reselling of bonds and how that relates to the interest rates and the price of the bond, but also including in there the concept of reselling at discounts and why that applies. So don't miss that discussion and conversation. Now I'd like to touch on the advantages and disadvantages to the bond issuer, meaning either the government or the corporation. And there are two fundamental advantages. Bonds allow for the government or the corporation to be able to clearly understand predictable fixed expenses that they would have to borrow money, and they can plan accordingly. And both governments and business and corporations like predictability so that they can work that into their planning for the future. The second advantage is that bondholders do not own part of the company or the government. Well, you can make an argument that if you're a citizen and you buy a bond, government bond, that you, as a citizen, own part of your government, certainly. And this is more important advantage from a corporation standpoint. A bondholder is different than a stockholder. A stockholder has a voice in how a corporation is managed. A bondholder is no different than a bank and does not have an active voice like a stockholder does in a company. And that can be an advantage to a corporation in terms of this relationship in borrowing money. And there are two disadvantages to the bond issuers. The first is that interest payments must be made to bondholders even during tough economic and business times. Secondly, if the bond issuer has poor financial health, and this particularly comes into play with regard to corporations, it'll make the sale of bonds to raise money difficult and also have an impact on the resale of bonds at discounts. Investors will question and hesitate investing in a corporation, as an example, that has poor financial health and is at risk of potentially going out of business. Let's consider the bond investor for a moment. Where can they go for information, and what type of information is available? Well, the two most common places that bond investors go for research information and evaluation of bonds are two organizations, Standard & Poor's and Moody's. They're the leading bond research and information houses. Secondly, bonds are rated by particularly Standard & Poor's and Moody's using a letter rating system, AAA, and then it goes down from there. And a thing to keep in mind, the higher the rating, like for example AAA being the highest rated, the less the risk in investing in the bond, but the other side of that coin is the lower the coupon rate or the lower is the return. Now let's take a look at the types of bonds. And there are four types of bonds. Three of the four types are government-issued bonds, and then there's the corporate bond. And we'll start with the government-issued bonds. And the first one I'd like to talk about is actually a bond that you may be familiar with. It's called a savings bond. You may have been given a savings bond for some life event, a graduation or a birthday as an example. And if you have them stuck somewhere like in a drawer or a cabinet, you want to make sure that you know where they are, organize them, put them in a folder, because remember, they're almost as good as cash because you can redeem them for cash at some time when they mature. So a savings bond, here's what it is. It's a low denomination bond that's issued by the federal government. And there's no risk, and I'm being a little facetious here with the question mark. Because of our national debt, I bring up that question of risk again. So it's usually considered very little risk. It's purchased for less than the par value. In other words, you see the $100 bond up here in the picture in the right-hand corner. you may actually buy this bond for $60 and you're buying it at less than the face value, and you get the face value at the maturity date when you go to redeem it. There is no interest paid on savings bonds, and the federal government usually or generally uses the money taken in from savings bonds for public works projects. If you're not familiar with the word denomination as we use it here in financial terms, it's a class of units having specified values, value amounts with regard to money or finances, designations, so forth. She had bills of different denominations in her wallet, 10s, 20s, 50s. Okay, the second type of government bond is called a treasury bond. And a treasury bond is issued by your federal government. It's an investment in your federal government. Again, I have the question mark on risk because I get a little worried about the national debt. And what the federal government issues treasury bonds for is to borrow money for the government, okay, and also to control the money supply. Now, the Federal Reserve Bank and system does this on behalf of the government, and it's the Federal Reserve that's doing this for these two purposes, either to borrow money on behalf of the government so that the government can use it for projects or to pay debts, and also the Federal Reserve Bank uses this to control the money supply, and we're going to study that in greater depth when we get to Chapter 19, where we look at a deeper study of the Federal Reserve Bank and also how it does control the economy through the control of the money supply. And the gains to you as the bond purchaser or investor are free of state and local taxes. Now, treasury bonds come in four versions. Here's the first one. T-bills. They're $10,000 bonds. They have a 13-week to 12-month maturity. They're bought at a discount. If you buy the $10,000 bond, you may buy it, for example, at $9,500. No interest is paid. When you redeem it at maturity, you're given the face value, the $10,000. The second type of treasury bond is called a treasury note. These range in denominations from, in round numbers, $1,000 to $5,000 bonds. They usually have a 2 to 10-year maturity, and in this case, they're not bought at a discount. They are paid semi-annual interest to the bondholder. The third type, or third version, is the treasury bond itself. These are $1,000 denominations and up, and have maturity dates of 10 years and beyond. These pay semi-annual interest. The fourth version of a treasury bond is called a zero coupon bond. These come in many denominations, have a wide range of maturities from 6 months to 30 years, very broad. They're sold at very deep discounts and no interest is paid, so you get the face value of the bond that you bought at the maturity date. Now, the third type of government bond is the municipal bond, commonly referred to by investment advisors as munis. They're issued by state and local governments, and they're used to fund local public works. Municipal bonds are generally low risk, and I have a question mark there because just like with the federal government, I think we'd have bigger problems if our local and state governments were going to disappear anytime soon. However, question mark is that although we have not had any states that have gone bankrupt, we have had municipalities that have gone bankrupt, and bondholders have wound up being hurt by that. So there is some risk. The gains are usually free from all taxes, federal, state, and local taxes. Municipal bonds are very popular investments and because of the safety and also the tax-free nature of them. They pay interest. They come in denominations of $5,000 and up, and they have a broad range of maturities from 1 to 40 years. Now, let's take a look at the fourth type of bond, which is the corporate bond. And there are 4 general characteristics to the corporate bond. First, remember, it's a loan that's made to a corporation, and they generally come with a wide range of maturities, from anywhere from 1 to 30-year type bonds, maturities. They are moderate risk, more so than obviously government bonds. They come in a wide range of denominations, anywhere from $1,000 on up, and where the Treasury bonds are regulated and managed by the Federal Reserve Bank and system for the government. The corporate bond is heavily scrutinized and watched and regulated by the Securities and Exchange Commission agency of the federal government. The next type of financial investment product we want to look at and have an overview of is the certificate of deposit, commonly referred to as CDs in the financial community. A certificate of deposit are funds that are deposited with a bank for a fixed amount of time in return for a modest profit. And CDs have 3 general characteristics. They're usually moderate-sized denominations, generally a range between $1,000 to $10,000 denominations. They're low risk, and the reason for that is their funds deposited with a bank are protected by the FDIC, the Federal Deposit Insurance Corporation, which I had mentioned at the end of Chapter 12. So the investor's investment is protected up to that $250,000. Thirdly, they're commonly used for IRAs, individual retirement accounts. The next investment product to look into is a money market account. Once again, these are funds that are deposited with a bank for a modest profit. And this profit will be above what you would get with a simple savings account, that's commonly called a passbook savings account, but lower than the CDs that we just looked at. Money market accounts have 3 characteristics. First, there's a minimum deposit required, usually $2,500, but there are relatively few restrictions put on the account. There's usually little risk, again, for the same reasons that we had with CDs, in that banks are insured by the Federal Deposit Insurance Corporation. So as long as you don't have over $250,000 in money market accounts with a bank, you should feel relatively secure with little risk. And third, by putting money into a money market account, you get additional bank services that come in different shapes and forms and formats, such as things like free checking, overdraft protection, and a host of others. And it depends upon which bank you have your money market account with. Next, we move on to considering stocks as an investment vehicle. You're familiar with stocks based upon what we covered in Chapter 9, Business Organizations, when we looked at the characteristics of a corporation. And you know, stock is a share of ownership in a company. In the financial community, stocks are also referred to as equities. Now, there are 3 benefits or possible benefits of owning stock. And here's the first one I'd like to talk about. It's called dividends. Not every corporation pays dividends to their stockholders. Some do. And you can think of a dividend sort of like an interest payment. And what the corporation will do is take a part of the corporation's profits and divide it by the number of shares of stock and pay that out per share to the stockholders. And when they do this, the corporations that do pay dividends, they usually do this 4 times a year. A second possible benefit of owning stock is that stock has the ability to potentially provide you with a capital gain. And what a capital gain is an appreciation of the stock price. If you're not familiar with the word appreciation, as it's used here, let me give you some background relating to financial issues. To rise in value, increase. He realized a significant appreciation in his stock portfolio as business conditions improved. Unlike a bond, which is static, meaning if you buy a $10,000 bond on maturity date, you'll get $10,000 back. Yes, you've earned interest during the period of time you've held the bond. Stock is different in that if you buy a share of stock at, let's say, $50, depending upon the corporation's performance, it's very possible that the value of the share of stock will increase to, let's say, $150, at which time you could sell the stock and realize the capital gain or the profit from the sale of the and the increased value. Now, something to be aware of. I have capital gain here and I have capital loss, and understanding both. Just as you could buy a share of stock for $50, and the corporation run into some hard times, and the value of the stock through the price drops down to $25, you could wind up losing money. And in a moment, I'll talk about the advantages and disadvantages of owning stock, one of which is that it's obviously far more risky than bonds. But also something to keep in mind, which is kind of sad in many ways, the government will tax you more significantly on capital gains as you make profits. As a matter of fact, there's a special separate capital gains tax that's higher than the income tax rate. So this goes back to the reference I made in Chapter 9 about double taxation. And that's at a pretty high rate versus a capital loss. The good news about a capital loss is that you can write off as a deduction in your taxes the money that you actually lost. However, it's not at the same rate of the write-off as the government taxes you on the other end about the gain. So there's a little bit of a discontinuity there. The next possible benefit of owning stock is that sometimes corporations do so well that they, for a number of reasons, to reward stockholders but also to try to raise more money, will actually split the shares of stock, and that multiplies your holdings, and that usually winds up working out to be pretty good for the investor, because the corporation would not do a stock split if they didn't think that the price of the share of stock will continually be going up in the future. So their prospects for their future business, they're feeling really good about. And I have a note here about talking about stock options as compensation. You may recall that I covered this during one of my talks in the course resource center in Chapter 9 when I was talking about initial public offerings and how the senior management of corporations are rewarded by exercising their stock options as part of their compensation package. Here are the two possible disadvantages of owning stock. As I mentioned a moment ago, they can be fairly risky. You can have the capital loss. I used the example of buying a share of stock at $50 and the company falling on hard times and the value of the stock declined to $25. So you do have risk involved. As a matter of fact, not only is there no limit to the upside in terms of stocks, in terms of how much you can gain, there's also no limit to the downside. The next disadvantage is that usually you would be last in line to collect in a bankruptcy of the company. Now, let's stop and think about this for a second. Remember, as a stockholder, you are technically an owner of the corporation. And if the corporation goes bankrupt, it needs to pay off all its debts and liquidate its assets to resolve everything and shut itself down. Now, if you're not familiar with the word bankruptcy, let's get that out of the way here. First, financially ruined, impoverished. The debt that they had accumulated led to bankruptcy. And as a stockholder, you are obligated to make sure that the corporation does resolve all its debts and pay things off before shutting down. So if we compare a stockholder to a bondholder is somebody that has loaned money to the corporation. And when there's a bankruptcy, they would stand in front of the line to collect before a stockholder ever would take anything away in the end. Now, stocks are classified in 4 different ways, 2 of which are associated with each other and the other 2 associated with each other. Now let me explain the 4 different ways to classify stocks. Here's the first way. Some stocks are considered income stocks. And what we mean by that, or I should back up and say, these are stocks that, as I mentioned before, some pay dividends. These are stocks that would pay dividends. Income stocks are stocks that consistently pay dividends. They're usually stocks of corporations that are very large corporations, global corporations that have been around for a very long time and that are very well off, meaning they're profitable and there's usually no threat to their business. Many times you'll hear these income stocks referred, and by the way, Exxon would be a good example of a company that would be considered having an income stock, as well as Johnson & Johnson, the pharmaceutical and consumer products company. And many times these will be known as widows and orphans stock. And here's the reason for that. That's a very old-fashioned term, that as people over many, many years, or close to 100 some years, have accumulated stock in these companies, and it has grown and multiplied through stock splits, and they've acquired more and more over time, they bequeath this to family members. And if the stock is passed down in families over time, it can become quite substantial, so much so to the point that with a husband and wife, if a husband were to die and had a portfolio of income stocks, or enough of an income stock that it could pay such dividends that the man's widow and children could live off of and not have to work, that's where the term comes from, widows and orphan stock. And that if you accumulate a significant amount of these income stocks, the amount of dividends they paid would be something that you could actually live on. The second classification of stocks is called growth stocks. These are companies that pay no dividends. They reinvest their earnings back into the corporation. The value to the stockholder usually comes in stock price appreciation. The example before of buying in at $50 and it going up to, let's say, $150. And most young, emerging, up-and-coming companies that have gone public and offer stock in the public market wind up being considered growth stocks and take this approach of no dividends and reinvesting the earnings. Some great examples would be eBay and Google. Now, here's 2 other different ways of classifying stock. It's just an entirely different perspective. Some stock is called common stock, and this is stock that's issued by a corporation that allows the stockholders to vote on the way a corporation is run, on policy and management issues, and also for members of the board of directors. But there's another type of stock that's also issued by corporations, and it's called preferred stock. In this case, if you're a preferred stockholder, you are a non-voting owner. However, you would receive dividends even if the company generally is not providing or offering dividends to stockholders, like if it was a growth stock. As an example, Google does have some preferred stockholders that do get some dividends. And also as a preferred stockholder, you would stand in line before the common stockholder to receive money from the sale of assets if the corporation went bankrupt and was liquidated. You see the word liquidation here. If you're not familiar with it used in these terms, it means to sell off assets to pay debt discharged. The liquidation sale of the company's assets was not enough to pay off all its debts. In this case, using that sentence as an example, not only would the common stockholders not get any money, but the preferred stockholders wouldn't get any money from the liquidation either. These next two investment vehicles, futures and options, I'm not going to spend a lot of time on here explaining because the average investor usually doesn't get involved with these. However, I will be giving an example, an illustration of why futures are particularly dangerous for investors in the Course Resource Center during some of our discussions. So let me give you the background quickly on these two. Futures are contracts to buy or sell commodities at a specific date in the future at a price specified today. If that sounds a little confusing or a little complex, it is, and that underlies the danger in getting involved in futures contracts. Unless you are deeply involved in a particular industry related to the commodity, the futures have a tendency to be a very dangerous, very high risk investment vehicle. So catch my explanation and illustrations in the Course Resource Center, and I think you'll understand what I mean. The other one, options, is something that we talked about earlier in this chapter and also going back to chapter 9, that options contracts are contracts that give investors a choice to buy discounted stock at a specified time, and they're usually used as part of a compensation package for corporate executives. The last investment product that I'll talk about here is the world's most popular investment product, and the likelihood of you buying into this type of investment product in your lifetime is very high or very probable. And you buy a mutual fund from a broker or buy into it through a broker. And what a mutual fund is a collection of financial products that's viewed as a single investment. And it's a very popular product that's used to make up 401k plans. And 401k plans I talked about in Chapter 9 as a benefit vehicle offered by corporations. And here are the advantages to a mutual fund. And by the way, before I talk about advantages, you don't necessarily have to work for a corporation to buy into a mutual fund through the 401k. You can do this independently as an individual and working with an investment broker. So the two advantages of mutual funds are that first, they're an easy way to diversify your investments. And I want to reemphasize that diversification is a very good strategy to protect yourself and reduce risk. The second advantage is that you're getting expert advice and management with regard to your investments. Mutual fund companies provide outstanding advisement and management advice for your investments. Now, they have two characteristics to the mutual funds. First, they typically include a portfolio of stocks, bonds, and other guaranteed savings plans. And they can be customized to be focused on either specific industries or specific markets. For example, there are mutual funds that invest in buying stocks and bonds in, let's say, the pharmaceutical industry or the telecommunications industry or the petroleum industry. Or you can look at mutual funds from a market perspective that may be buying the stocks and bonds of corporations in certain foreign markets, like, let's say, China's up-and-coming corporation. So you can make it geographically market-oriented, or maybe sections of the country. So there's a lot of flexibility to customize the mutual funds for your investments. In this next section of this chapter, we're going to take a look at the financial markets and how they're organized and how they work. And for starters, what we should do is define what a financial system is and give you a working definition for that. A financial system is made up of savers and borrowers that allows the transfer of money between them. Quite a few things can have an effect on the financial system and financial markets. Some of them positive, some of them negative. For example, simple economics, changing supply and demand in markets can have a significant effect. Innovation, we've seen the effects of creative destruction through innovation and how it's created new markets and spurred economic growth. Political trends can have an effect. Conflict and wars certainly have an effect on the financial system and markets by the destruction of resources and assets. Weather can have an effect, natural disasters like earthquakes. Even bad decision-making and corruption can have an adverse effect to the financial system, and I should probably extend that even further to say I've seen rumors even have a negative effect on the financial markets. And now for a brief overview of how the financial system is organized. And it's organized into two parts. Here's the first. It's called the financial assets markets. It's how the products, many of which we've just talked about, are organized for buying and selling. And the other part are the exchanges, which is actually where the products are bought and sold. Let me start with giving you a little more detail with regard to the financial assets markets. And conceptually, there are two financial asset markets. Here's the first. It's called the capital market. This is the conceptual market in which money is loaned or invested for periods of longer than a year. The products that make up this market in terms of the buying and selling are things like corporate bonds, long-term CDs, large long-term treasury notes and bonds. The other conceptual financial asset market is the money market. This is the conceptual market in which money is loaned or invested for periods of less than a year. And some of the products that are exchanged in this conceptual market are short-term certificates of deposit, treasury bills, and the mutual funds that we looked at. Now let's switch over to the other side, the physical, I shouldn't say physical, the places, physical is one of them, but the places where the financial assets and products are actually exchanged. And they come in both physical and virtual forms, the types of exchanges. And let's take a look at these. The first one I'd like to talk about is a stock exchange. This is where stocks and bonds are exchanged. And I'm going to give you two examples, one a physical example and the other a virtual example. The physical example would be the New York Stock Exchange. And you can see the actual New York Stock Exchange, a picture of it in the upper right-hand corner of this slide. It's actually a physical place where the exchange of stocks and bonds occurs. An example of a virtual stock exchange is the NASDAQ. This is the National Association of Securities Dealers Automated Quotation System. It's effectively an online stock market. A second type of exchange is called a commodity exchange, and this is where resources and raw materials are traded. Everything from oil to agricultural products, to gold and precious stones, you name it, any type of commodity or raw material or resources traded here. And these types of exchanges also come in physical form and virtual form. For example, there's the New York Mercantile Exchange, and the picture that you see at the bottom of the screen here is an example of a physical version of a commodity exchange. It's actually the Chicago Board of Trade. And a third type of exchange is a foreign currency exchange, the most famous of which is Forex. This is where currencies are traded one for another. And if you've traveled through an airport, you may have actually seen a booth that is a physical presence of a currency exchange, but they also come in virtual forms. There are treasury departments within corporations that actually do online trading of currencies through virtual currency exchanges to support the corporation's financial positions. We will delve into why countries and people would want to do currency exchanges in Chapter 19 with regard to monetary policy, and also Chapter 20 where we look at global trade. We do a little bit deeper study in that, so you can look forward to that coming in the not too distant future here. In summarizing a bit with regard to investment products, I want to take a moment and mention where you can go for investment products. First, as we've talked about, banks, they provide quite a few different investment products, everything from money market accounts and certificates of deposits, but also now stocks and bonds through separate arm's length divisions of the banks with the repeal of the Glass-Steagall Act, which I had mentioned at the end of Chapter 12 a couple of years ago. Actually, insurance companies also offer some investment products in the form of CDs and special types of funds. And then we've mentioned the brokerage companies, which you can find your classic stocks and bonds, futures, certificates of deposit, and some other, most importantly, mutual funds, and some other bank services that we had mentioned as well. As we move towards wrapping up this chapter, I want to spend a few moments providing an overview of some of the aspects about how we measure the performance of the financial system. And in doing so, we use 5 items. First, we look at the M1 and M2 portions of the money supply very closely and monitor those. We also monitor commodity contracts that are being traded and the prices associated with them. However, the most well-known aspect of the measurement of the financial system comes in the form of the Dow Jones Industrial Average, commonly short known as the Dow. What this is a measurement, it's a collective measurement of the stock performance index of 30 major companies that are supposed to truly represent the United States economy across a number of industries. We monitor the value associated with the stocks and their price performance in the stock market. Quite often, if you listen to a news report in the morning, at the tail end of the news report, they'll give you the information on the Dow Jones Industrial Average from the prior day as to whether the market was up or down. And also associated with that, they may even give you the information on this measurement, which is secondary to the Dow Jones Industrial Average. It's called the S&P, standing for Standard & Poor's 500. This is a little broader view than the Dow Jones Industrial Average. It measures the collective stock price performance of not 30 but 500 companies within our economy, and it gives you a little bit broader measure of the overall stock market. There are also some other indexes, what we call specialty indexes, that measure the performance of specific industries or markets. Some examples that you may hear about in the future are the Russell 500 or the Wilshire 2000. If you begin to listen to news reports about how the financial markets and the financial system is doing on a regular basis, you may get introduced to these two guys and what they represent, the bull and the bear. These are terms that are used to describe market conditions that are characteristic of the two animals. If it's described that we're going through a period of a bear market, what people are describing is a poor set of business conditions with little investing going on. It's a down market and prices are probably declining. That is, prices for stocks and bonds and so forth. If they're talking about a bull market, they're talking about a market that has good business conditions going on within it, and there's a lot of investing going on, and the market is on its way up, and prices are on their way up, and things are getting better. Kind of like characteristic of a bull rampaging around versus a bear hibernating and withdrawing. So these are two very commonly used terms to describe some broad market conditions. The last thing that I want to cover in this chapter is an overview of the 6 things that in combination can cause financial markets to fail, as they did in 1929, 1987, 2001, and 2008. And a few moments ago I talked about things that can have negative effects on the financial markets, but I want to focus in specifically on one of the things I had mentioned, which is bad decision making. I will also in this section talk in a few moments about the things that are being put in place to try to prevent complete market crashes and failures. So here are the 6 things that in combination can cause the financial markets to fail based upon generally bad decision making. The first is stock speculation. This is when investors buy stock on rumor or a hunch without any analysis, going into it blindly, not being informed, and putting their money at great risk. Secondly, and usually closely associated with stock speculation, is the action of margin buys, which is buying stock with credit. So imagine this: we have an investor that's going to go off based upon a rumor and buy stock that the rumor might not be true, and they may wind up getting hurt, but they do it on credit, meaning they borrow the money to buy the stock. So they go in, and I'll use that example of buying a share of stock for $50, and the rumor isn't true, and as a matter of fact, some bad happens and the stock drops to $25. It creates a doubly bad situation in that they didn't have the money to buy it at $50 to begin with. They borrowed it, and now they're in a hole with not only owing the money, but trying to find additional money since they lost value. These two things in combination are very bad. As I mentioned a moment ago, these things happen in combination to create the failure. And when you have stock speculation going on, that increases demand for the stocks, and that will increase, therefore, the prices. And when the prices soar far above the real value of the companies, that's when you have the potential for a disaster, especially with the people who are doing the margin buys using the credit. Now, some other things happen in combination here usually as well. You usually see when the markets fail that consumer and government debt has been increasing. And what happens is the financial institutions start to get nervous when they see these trends, and they start to call in loans. And yes, by the way, all types of loans, business loans, mortgages, whatever, the bank, if you read the fine print, most banks have in there the right to call in a loan whenever they see fit. And when they do, you have to have the money. You can't negotiate your way out of that. And they usually are calling it in for a reason in terms of market conditions. So banks get nervous, financial institutions get nervous, they call in loans. That tightens up the credit market. and one thing starts to lead to another, and some of the panic starts to set in both on the business side and the investor side. And then what we usually see working in conjunction with a market failure is sectors of the economy begin to fall upon hard times with rising unemployment. And lastly, there have been some new weapons developed and designed to try to prevent complete crashes, and some of these have been very controversial. I'll start with the first one, which is not. We've been able to take advantage of our technology advancements to put in market controls, what they call circuit breakers, that actually will shut down the exchanges when the market show signs of overheating based upon the speculation and other types of economic conditions. So that happens to be a good weapon, if you will, and it has been used effectively a number of times in recent years. Now here come the controversial weapons designed to prevent complete crashes. The first is new powers in 2008 that was given to the Federal Reserve Bank and system to be able to set reserve requirements for brokers and loans, and also offer loans to any corporation. Now this fringes upon, in many people's minds, our free market principles in terms of government or quasi-government institutions sticking their arms deeply into the free market. So that's why this has been controversial. But even more controversial than that has been the new powers given in 2008 to the Treasury Department, where the federal government in the financial crisis of 2008 and during the Great Recession actually took ownership stakes in private corporations, not probably the most famous of which was the fact that the federal government became the actual owner, majority owner, stock owner of General Motors. So that also has set some people off in terms of questioning whether we have given up some free market principles in the effort to avoid complete market crashes, and we'll see where that goes for the future. Well, that brings us to the end of Chapter 13, Financial Markets and Financial Products. We're going to start to make our move very heavily into further into our study of macroeconomics and looking at, in Chapter 14, major economic challenges such as inflation, poverty, and unemployment. And we'll see you there.